In this presentation, we will take a look at recording transactions related to a lease financing agreement for the debt service fund, comparing and contrasting the debt service fund and the government-wide activities. We're going to start off with the government-wide activities being on the accrual basis. So we'll be able to put this together on the accrual basis and then take a look at the debt service fund, which will be on the modified accrual basis. So we want to construct the journal entry in the government-wide activities and then think about how it will be modified in order to go to the modified accrual settings of the debt service fund. So here's our information up top. We have the capital lease for capital projects. The scenario is that we have a capital lease related to a capital project, which will be a building. That information includes installments at year end of $483,000, total to be paid $2,898,000. So if we take that $2,898,000 divided by the 483,000, that's going to be 6 payments. The amount then is going to be 8% of interest. Then the present value of the lease is going to be $2,850,441. The fair market value $2,930,000. Initial payment that we're going to make now $483,000. So in essence, we're going to put this on the books like we would in a capital lease type of activity rather than an operating lease. So we are in essence going to put this on the books in terms of the asset being recorded, the payment being recorded, and the related loan or equivalent to like a loan as if we were to be purchasing the building at this point in time. So if we look at that, we're going to say the building's going to go on the books. We've got the cash. We're going to pay the $483,000. So we're going to credit the $483,000. Then we're going to credit the lease obligation payable. The lease obligation payable then being the $2,367,441. That's going to be equivalent to the present value of the lease payments, which is going to be the $2,850,441 minus what we're paying here, $483,000, and that's going to be the $2,367,441, and therefore the building is going to go on the books. It's going on the books for the present value of the lease payments. So we got the present value of the lease payments. That's what we're putting it on the books for. We've got the cash that we paid, and then we have the lease obligation payable, putting it on the books as we would kind of like a loan, as if we were purchasing the building, financing the building. If we record this, then we're going to say that the building is going to be increasing in the debit direction, and then the cash is going to be going down. So we're paying out the cash, decreasing the cash, and then we have the lease obligation, the payable, on the books, and that's going to be a liability account, the liability account going up in the credit direction. Now we want to think about this and say, okay, this is going to be related to the funds now, the funds including the capital project fund and the debt service fund. Our focus here is on the debt service fund, but of course this will be affecting both the capital project fund and the debt service fund. In neither fund will we be recording the building itself or the lease obligation payable, because the building is going to be a long-term asset, which isn't going to be on the funds. Either fund, both funds being the governmental funds, on a modified accrual basis as opposed to the accrual basis, and neither fund then having long-term liabilities as is the lease obligation, and therefore we're not going to have the lease obligation on either fund as well. So let's take a look at what we will have. In the debt service fund, we're going to record, in essence, the payment made. We have the expenditure principal of the lease obligation. So you'll note what we're not doing. We're not putting it on the books as a liability and then recording the decrease in the liability. In essence, with the payments, we're recording the expenditure for the principal of the lease obligation as we paid it here, and then we're going to credit the cash in the debt service fund. Nothing in terms of the long-term liability, nothing in terms of the long-term asset on the books. Recording that then, we've got the debit to the expenditure going up in the debit direction, then the credit to cash. So cash then going down. It has a debit balance, of course, and we're decreasing it. What about the capital projects fund? So within the capital projects fund, we're going to record the expenditure related to the $2,367,441, because that's what's being used to finance the capital project. And of course, that's the present value of the lease payments to $2,850,441 minus the $483,000 that we paid. That's going to be the $2,367,441. That's the amount we're going to basically use to finance within the capital project fund. Once again, it not going on the books as a liability. You'll recall this credit in the government-wide activities went on the books as a liability. Here, it's going to go on the books as other financing sources, lease agreement. When we record this, then we've got the expenditures increasing in the debit direction, and then the other side going to something similar to acting like a revenue type of account. The other financing sources increasing in the credit direction. Now we're going to go back to the government-wide activity. We're going to pretend it's the end of the year now when we're going to make the first payment on the lease. So we're in the government-wide activity. We basically put it on the books as a capital lease. Now we're going to make the payment on a normal type of accrual type of basis on the government-wide activity. So if we make the payment, then we're going to be paying down this lease obligation. We're going to be paying down cash with it. Cash is going to go down. And then we are, of course, going to have some type of interest related to this as well. So if we look at the transaction, we're going to say cash is decreasing. We're going to pay down the lease obligation, and then we have the interest. So you'll recall that the amount we're paying is the $483,000. Then we want to see, well, what's going to be the interest portion of it? It's going to be 8%. So we're going to say that we have the 2367441 times 0.08. That gives us the interest percent of the 189,395. So the cash being paid minus the interest portion is going to be the decrease in the lease obligation. So if we post that out, then we're going to say that the interest expense down below, we have the interest, it's going to go up in the debit direction. Then we have the lease obligation. It's on the books as a liability. We're decreasing the liability. And then we have the cash. Cash is on the books, obviously, as an asset. We're decreasing the cash that is being paid for it. Then we want to think about, well, what's going to happen in terms of the fund accounting? We're going to be recording this in the debt service fund. We got the cash is still going to be going down, but we're not going to have this lease obligation payable because that's going to be a liability account not on the fund accounting for the governmental funds because they're on a modified accrual basis. Therefore, when we go to the debt service fund, it's going to look like this. We're going to have the debit to the expenditure for the interest. That looks kind of normal or similar or what we would expect. The expenditure then also, however, for the principal, the reduction in principal, then go into what we would think of as more of a temporary or income statement type of account with relation to the debt service fund, it being on a modified accrual as opposed to the accrual basis for the government-wide activities. Then we're going to credit the cash. So if we record this out, we have the cash decreasing, of course. So we've got the cash debit, decreasing the cash. Then we're going to record the expenditure for both the interest and the principal down here, interest and principal being recorded on the temporary type of accounts, acting similar to as an expense would.